Good morning, everyone, and welcome. I'm Kate Thorley, the CEO of Wilson Asset Management, and it's my great pleasure to welcome you all here this morning. As a team, we just love going around the country and doing these investor presentations and having the chance to catch up with our shareholders. So we really appreciate you coming along. I'll just introduce the team. Jeff Wilson, our chairman and founder. In the front row over here, we have John Ayub, a senior equity analyst. Matt Haupt, you boys want to stand up? Portfolio manager. One of the newest additions to our team is Cooper Brady, who joined us just a week ago. He is an assistant dealer and has moved across from WA. Who else have we got? Oh, well, we'll cover off on the rest of the team once they make their way inside. I mentioned we'll be going around the country this week. We're also partnering with Livewire, who are live streaming today's presentation to enable anyone that can't get along to the presentations to be able to tune in. So that's great, and we really appreciate their support. That's the disclaimer. So obviously we're not offering any personal financial advice, and just a point in terms of our view on the market and any stocks that we talk about, our view on those stocks can change quite rapidly. So bear that in mind when you're listening today. The agenda, I'm going to cover off a little bit about Wilson Asset Management. Jeff will then talk about each of the listed investment companies and the current capital raisings that are open this week. That's Century Australia and WAM Microcap, and there's prospectuses outside on your way in, if you didn't get one on your way in. We'll then hand over to the investment team, who will talk about their view of the market, some current investment trends and themes that they've been seeing while they've been out visiting companies. They'll then talk about the investment portfolio and drill into a number of stocks that we currently hold, some stocks that we like, stocks that have worked, and also stocks that haven't worked. Alex Hopper, our senior communications advisor, will then take us through a moderated Q&A, and then we'll open up to the floor for questions. Following the presentation, we'll have lunch for half an hour at 12, and then I'd encourage you all to stay around. We've got quite a big afternoon. The Future Generation Investment Forum is on at 12:30 until 3, and it's going to be quite exciting. We've got 12 of our best performing Australian equity and global equity managers, and they're all pitching one or two stock ideas for 5 minutes each. So I'd encourage anyone that hasn't registered, please stick around for that forum. It should be a really great afternoon. So a little bit about us. For those of you who aren't familiar with our business, Wilson Asset Management, we've been operating for almost 2 decades, and we are the investment manager for 5 listed investment companies, managing over $2 billion for almost 50,000 shareholders. We have 8 investment professionals now who have collectively over 100 years of share market experience. We have a proven investment approach, and as I said, we've been operating for almost 2 decades. WAM Capital, our flagship fund, has been able to outperform the market by over 10% per annum over that time. And really, in terms of our approach, we have a very flexible mandate. We ensure that we have a focus on delivering fully franked dividends to our shareholders. And also, we're big supporters of the LIC structure. We believe that is the superior investment structure for managing your money. They're closed pools of capital, and really it means that the investment team can just be totally focused on picking stocks and making money, as opposed to worrying about shareholders buying and selling. At Wilson Asset Management, we're also committed to wanting to make a difference in the both to our shareholders but also to the community in which we operate. One of the ways that we do that is through our continued support of the future generation vehicles. So the investment team are managing some money for FGX on a pro bono basis, but we also as a team provide support in terms of finance support, administrative support, marketing and communications support. So these vehicles were founded by Jeff over the last sort of 3 or 4 years, and effectively the fund managers that are managing the money are doing it on a pro bono basis. All the service providers are working pro bono, and it means that the vehicles are able to give away 1% of their assets to a number of charities. So they're great investment vehicles. This is a slide of our investment and management team. There is a team of 26 of us now here in the Sydney office, and as I said, 8 investment professionals led by Chris Stott, our Chief Investment Officer. I feel very fortunate to work alongside such a talented and passionate group of individuals, and that slide doesn't sort of show. We've also got an amazing team of accountants and finance professionals, and an incredible team of marketing and communications team, which ensure that we engage with our shareholders and communicate effectively with you. We also have operations and support and administrative support team here, and there's quite a lot of the team here today, so please make sure that you have a talk to them and ask any questions that you might have. I'll now hand over to Jeff for the next slide. Thank you.
Thanks, Kate. The last picture, you look like the rose between a lot of thorns. In terms of personnel, I think, are we 50% male, 50% female in the office? I think, that's not myself personally. Or maybe in this day and age it should be. But anyway, getting back to our funds, and when I was out the front talking to some of the shareholders, a theme that came across from a couple of people I was speaking to was, are you spreading yourself too thin in terms of what you're doing? You see a lot of entities there, as in companies, and I can understand why you'd think that. As fund managers, and now, as Kate mentioned, there's 8 in the investment management team, so we are a large investment management team to be only managing $2 billion. I know it sounds like a big amount of money, and it is, but I would say we're one of the bigger teams that is managing that pool of money. What we really do is we only do one thing, and that's we try to buy undervalued growth companies, and we'll sit in cash until we can find those companies, and we'll buy them when we can see a catalyst that's going to change the valuation of that company. That's what we do. So the fact that it's split into those various entities may look like we're doing a lot, but we're not. In terms of the pool of capital we're managing, this a little over $2 billion, there are, again, it's split in broadly in 2 parts, and that is the large companies which Matt Hout and Johnny Ayub manage, and they're responsible for that, and then the rest of the money, which is invest anywhere in the market but really focus on mid and small caps, is the other 6 of us that we focus on. So if we find an undervalued growth company and we can find a catalyst that's going to change the valuation and we buy it, then the question is, where does it get, in what entity does it get allocated to? and you'd be aware, that those that have seen us present before, our investment process is very labour intensive. We have meetings. We believe the best quality of information comes from the companies the management that manage the companies, and we'd have over 1,500 company meetings a year. And the question is, again, another question, like why are you doing Century Australia, and why are you doing microcap? Each time let's take a step back a year. Why do we do WAM Leaders? When we've added these entities, we've added them because we believe that it'll improve how we manage money. The fact that we've now got two people totally focused on the top 200, which is, it's very competitive to manage money in that area. And that's why we've always focused, probably we've always looked for the low-hanging fruit, looking at mid and small-sized companies, which brokers really don't spend that much time researching, and we believe we can find good opportunities there. But by putting the resources to look at the larger companies, we really do get a significant benefit in terms of information. And in this game, to me, the best quality of information wins. And that's what we're trying to do, get the best quality of information. Why have we created WAM Microcap? As we've grown in size, and say WAM's $1.2 billion now, when we see, say, a $50 million company or a $40 million company, then do we think, well, do we want to put, say, $500,000 or $1 million in that of 1.2 billion? If it goes up 100%, then it adds, for WAM, say 0.001% in terms of performance. So what we didn't want to do is stop really focusing on those smaller companies. And when we're sitting down, and 6 or 7 months ago, we were talking about what else do we need to focus on to improve how we invest money. This was the investment team was saying, look, we really need to be totally focused on microcap, because the risk is we'll miss the next Flight Centre. I mean, everyone remembers when Flight Centre floated at 60 cents a share. Or we'll miss those first 2 or 3 years of a company's evolution. So from a business perspective, I questioned the guys. I said, look, if we want to raise more money, we're better off just raising $150 million in WAM Capital, and rather than create a new entity. But we concluded it would actually be better for us as fund managers if we did create the entity. Initially, we were going to restrict it. We said, look, just offer it to the WAM shareholders, and let's raise a small amount of money, say 110 mil, from a funds management perspective. And then the decision was, look, we probably need to have a little bit of room there. Let some of the brokers wanted some of their clients to participate as well. So we decided we'd raise the $150 million. There's no option issue with microcap, and that's because we don't want to raise any more money than that. Depending on the demand, we may have to upscale it. We'd prefer not to, but that's the logic. So all those entities there are, as I said, there's one broad strategy. It's undervalued growth companies, and then it really is a question of where, say if we buy $5 million worth of stock, where it gets allocated. That's effectively what they do, the various strategies. The undervalued growth companies, that's the research-driven strategy. Otherwise, we'll sit in cash. And while we're sitting in cash, if we believe we can participate in an IPO, buy a listed investment company at a discount to NTA, take a block of stock at a discount to the market and make some money, then we will trade that, and that's the market-driven part of the portfolio. If you're looking at the various entities, I'll just quickly run you through them. That's WAM Capital. A few people asked outside, oh look, what happened to the share price of WAM Capital yesterday? And I mean, the great thing about the market is no one knows. So probably I got no idea, but if I wanted to make up a thesis of what may have happened, then it probably goes along these lines. About 6 months ago, after WAM Capital went ex-dividend and after WAM Research went ex-dividend, for those that have been shareholders for a while, both of them, within a couple of weeks of each other, all of a sudden gapped down by I think it was 5 or 10 cents. What tends to happen, when we announce the dividends, there's usually a lot of buying into the dividends, and when we go ex-dividend, they usually come under a little bit of pressure. And that's the only explanation I've got. Whether a financial planner gave a broker, said, look, sell $1 million or something like that, and the broker was quite brutal on how they executed the order, I'm not sure. We're at the airport in Melbourne yesterday coming back, and we're all looking at each other saying, geez, what did we say yesterday in Melbourne? And they concluded to say, Jeff, you were bearish as you always are, but you weren't overly negative on anything. And in terms of WAM Capital, you'd all be aware, you would have all recently got the dividend, the 7.5 cent interim dividend. The profit reserve at the moment is around a little under 17 cents. So the plan will be to pay another 7.5 cent dividend the full year. So everything's still on track. I mean, it is trading at a premium to NTA, and we like buying discounts to NTAs, but we've talked about that before. In terms of WAM leaders, you see the dividend there, 1 cent. The WAM leaders has a undiluted profit reserve of a little over 6 cents. Obviously the options are still outstanding, so depending on how many of those options get exercised when they expire, that'll reduce the profit reserve. But broadly, the board believes we're on track to increase that dividend from 1 cent to whether it's something along the lines of 2 cents in the full year. And the plan will be to, obviously, the plan is to make more profits and continue to perform. With WAM Research, it paid a 4.5 cent interim dividend. WAM Research has a very significant profit reserve, probably of all the listed investment companies has the largest profit reserve. That's around 32 cents. So the final dividend of 4.5 cents is well and truly, it's probably, what have we got? We've got 4 odd years or so of dividends up our sleeve, assuming there's no more profit made for WAM Research. WAM Active, which is the smallest of our listed investment companies, and the funny thing is that strategy is probably still very scalable for us. We don't think we can. We think WAM Capital is about where it is, as a good size, same as WAM Research, but WAM Active would continue to like to grow. That's back on dividend-paying territory, and we've got a little under 7 cents in the profit reserve there. So the full-year dividend of 2.5 cents is well and truly covered. Just with Century Australia, you would have seen recently that we've taken over the management of Century Australia. That is a listed investment company that was set up 2004 by Peter Morgan when he set up 452. Eventually, unfortunately, Pete was misdiagnosed with brain cancer and ended up going through chemotherapy, etc., etc. But over that period of time, he closed down his funds management business. Around that time, we approached Century when they were looking to do what they do with the company. They're looking for a new manager. We said we'd like to take it over, and the board then decided that wasn't they didn't agree with that strategy. A couple of years ago, we offered to take it over again, but the board then was saying, look, there's quite decent amount of tax losses there, and they wanted us to pay for those tax losses. And we weren't prepared to pay anything for the tax losses. So as those that have been around for a while would be aware, that we were going to use Century Australia for WAM leaders, and in the end it was going to take too long, so we ended up doing our own prospectus for WAM leaders. And then we still had we had bought a reasonable large position in Century Australia initially when they were trading at a 15% discount to NTA. And then the question is, what happens with Century Australia? We had a lot of WAM shareholders that are also in Century Australia, so we put a proposal to the board the latter part of last year saying, look, we're happy to manage it, and of course our first goal is to make up those tax losses, and we're raising money for Century Australia at the moment. It's investment mandate. WAM Leaders is the top 200 companies, Century is the top 300 companies. It is paying a dividend from its investments. Once the tax losses have been utilised, then obviously the dividend will probably increase. So if you're interested, someone asked me outside, they said, look, doesn't it make sense? In terms of Century Australia, Matt and John will be managing that pool of capital. And they're saying, doesn't it make sense that it fits with WAM Leaders at some point in time? And who knows? That could occur one day. But the initial focus is really to utilise those tax losses and let the company grow and manage the money as we like managing the money, with more of an absolute bias. In terms of WAM Microcap, I've pretty much gone through the logic there. Some people are saying, oh look, you're returning to your knitting, because when we started WAM Capital, we only raised a little over $20 million, and in those days you could invest in any listed company because you were so small. So there are some of the companies that we'd made good money on. I talked about the priority allocation. Any WAM shareholders, some people have asked me, look, I own shares in my name and I'd like to take it in my super name. Just fill out the WAM priority, and then we know you're part of the WAM family. It closes it opened yesterday, and the priority closes on the 5th of June. The actual issue closes on the 14th of June. Now I'll pass over to Chris Stott, who'll take you through the next part of the presentation. Thanks.
Thank you, Jeff, and good morning, everybody. What I'll briefly take you through is just some of the key slides on our current views around the market, and just some key themes that we've been coming across in our various portfolios in the last 6 months since we last met here in Sydney. First point to make is, we talk about the point here on the slide, messages from Canberra. One of the big benefits that we've spoken to you about over the last 5 years in particular is we're getting better access. We're getting better access to companies that we ever have before. We're getting better access to listed competitors, enabling us to do more in-depth research and have a far deeper understanding of all the companies that we invest in. And more recently, I was very lucky enough to be part of a small group that we went down to Canberra for a few days and had small group meetings with all the senior politicians in Parliament House back in mid to late March. And some of the key things that came out of that particular trip, firstly, I know a lot of you in this room own shares, have a self-managed super fund or rely on franking credits quite a bit. I've got a very good understanding that the Labor Party will not amend the imputation system, that franking's here to stay if we do get a Labor-led government, which in our opinion we think we will, next term federally. So certainly no expected changes to the imputation system or franking, which we think is obviously a clear benefit for a lot of people in this room and retirees more generally. So that was the first point to make. Secondly, the key other topic as well is first the budget, which came out last week, and the two key two key areas. Firstly, we saw the announcement of the $25 billion of extra infrastructure spend, which will flow through and benefit our shareholdings in companies like Downer and Lendlease in particular, Boral to as well, and we own those in WAM Leaders and some of those in WAM Capital. And also the bank tax, which was quite topical, which on our estimates it impacts their earnings per share by around 5% if the banks don't pass on. And the expectation amongst shareholders and the investment community alike is that the banks will look to pass that extra tax on to consumers, whether it be in the form of repricing of their mortgage book, on their term deposit book. The beautiful thing is with banks, they've got so many levers to pull in terms of their ability to generate profits. So the key will be, in our opinion, will be the regulatory oversight that occurs now within the banking system over the next year or two, particularly around this bank tax, which looks as though will be passed through and implemented on 1 July. So the obvious question is, well, what happens to bank dividends? What do the banks do with their dividends on the back of this 5% estimated earnings per share hit? All else being equal, bank dividends should fall by 5% if they do see their earnings fall down by that level. So it remains to be seen how the banks do react and behave over the next 6 to 12 months in particular on the implementation of this bank tax. Another key theme which came up in the meetings in Canberra was North Korea, the fear around North Korea and what their capability is like, particularly in the nuclear weapons armour, which they've been showing off to the world, as you know, in more recent months. So it's a heightened level of awareness at the moment in Canberra from a geopolitical standpoint around the North Koreans and what they may or may not do into the future. For us, how does that impact us as investors and privileged to be in a position where we manage all your money on behalf of you? Clearly that is a risk to the share market. If there was an event which was led by the North Koreans, that would clearly create a significant amount of volatility in the share market from the shorter term, but very, very hard to try and price that in as we stand here today. In terms of bringing it back to the Australian economy, where are we at? We're in this below trend cycle. We're experiencing this below trend economic growth that's been with us now really since the GFC, which was almost a decade ago now, back in 2008 and in the early parts of 2009. The Australian economy, we've put some quotes there on the slide, some feedback the type of feedback that we receive from the 1,500 companies a year that we meet with right around the country. As a team of 8, we're very active in meeting these companies. And some of the key points we've put on the slide there, the economy remains quite patchy, much the same as it's been in the last 3 to 5 years. Just more shorter term, we've noticed that the retail sector has really started to struggle, particularly for 2 reasons. Firstly, we've seen the banks starting to put up interest rates out of cycle. This was before the bank tax was announced at the budget of last week. But secondly, there's a large amount of fear around Amazon, and we'll talk a little bit later on in the presentation in more detail around what Amazon means for the retail space. But there has been some anecdotal feedback we've received from our contacts on the ground in the unlisted space that the economy has certainly stalled in more recent months, and we've reflected that on there where the consumer remains quite fragile. But even though we're in this slow growth period and it looks as though it's with us to stay for the next few years, we're still able to find companies that are continuing to excel, to continuing to grow no matter what the economy is doing. And Challenger is one stock that fits into our portfolios quite well at the moment in WAM Leaders and WAM Capital, in WAM Research, which we'll also talk a little bit about in more detail later on in the presentation. So in essence, what we're trying to do are find those growth companies and find those companies that are growing no matter what the macroeconomic or the economic conditions are throwing up, both domestically and from an international standpoint as well. The Australian housing market has peaked. 6 months ago we spoke to you, we thought that the housing market was approaching a top. We've now got clear evidence of this, which I'll talk about on the next slide. We've seen Sydney and Melbourne property prices in particular experience rapid growth over the last 5 to 7 years in particular, well north of 50%, depending on which suburbs and which areas of those particular states you look in. And certainly that's really been fuelled, as it normally is, by previous cycles, by low interest rates. We've seen record low interest rates, a cash rate at 1.5%, an all-time record low. We've never seen it before. The consumer has been deleveraging to an extent, but certainly in more recent times, we're now taking debt back on, and that's starting to see house prices starting to cool off a bit, which is much needed in our opinion from a longer term standpoint. We've been quite poor, if you like, in terms of adding new housing supply, building new homes and the like, with our growing population and now in Australia approaching that $25 million mark. That's really been a key factor, if you like, in why house prices have gone up so strongly in the last decade or two, and have been even stronger, as you know, in more recent times here in New South Wales and in Victoria. We spoke about how the regulators acting. What remains to be seen how they or where they intervene in terms of the bank's capital requirements as well going forward over the next 6 to 12 months. But I think the key will be what they do in terms of interest rates and whether the banks will continue to pass on these out-of-cycle interest rate rises. And as we go forward into the next federal election, which is touted to be in 2019, early parts of 2019 calendar year, one of the centrepiece bits of policy which the Labor government, or the Labor opposition, will bring to the next election campaign, and they've talked about this before, is that they're calling for a royal commission on the banks, and they're very much, that's one of their key headline policies, in addition to abolishing negative gearing for property, which would obviously have a negative impact, in our opinion, on the prices of residential properties if that was to occur. So there's some of the key things that key themes that we're watching for over the next year or two, in particular with the housing market. And this next slide just gives you clear evidence of the housing market that has now peaked. The key line to focus on here is the yellow or orange line. It does look orange. Might be a bit colourblind. You can see there that it has clearly peaked. You saw that large run up, over 20,000 new approvals we were getting up to around 6 to 12 months ago, and that has certainly come back in more recent times. And you can see here the other key point to make in this slide is that this particular housing cycle has really been driven by what we call multi-res housing, or high-rise apartments or units that have been built, in particular in parts of Sydney and in Melbourne. And we've spoken about this before. There are different parts of the two different states where there appears to be a large oversupply of apartments occurring now, and we think over the next few years we'll start to see that supply exceed demand in terms of high-rise apartments that are being built at such a rapid rate. And that makes sense for them to have been built in the last 5 years. We've had an undersupply of homes, we've had record low interest rates, and so the economics for these property developers stack up in terms of their ability to profit from these various property projects that they've been and continue to construct over the next few years. This next slide gives you a sense of household debt, and the key message I'd like to share with you today with this particular slide is if you look at that black line, which gives you, shows you the level of household debt as a percentage, and we go back to 1959, you can see that we've had this enormous growth in the level of household debt in Australia, and it's continued to rise fairly steadily over that longer time period. And you can see there from that period of, say, 2008, 2009 to 2012, so around that 3 to 4 year period, we tried to de-lever as a consumer. We went through the GFC. We didn't actually have a technical recession here in Australia, albeit it did feel like a mild recession at different moments in time, back in 2009 in particular. We didn't do a good job in terms of, as a consumer, de-leveraging our own balance sheets, i.e. paying down our home loans, paying down our credit cards, freeing ourselves up of debt, which certainly, as you can see into that 2007 period, rose at a rapid rate. And you can see more recently that the level of household debt has continued to rise again in more recent years, in the last couple of years, which is really a function of the blue line, which has seen level of household interest payments fall, with the benefiting from the lower interest rates coming through. We've seen consumers starting to gear up again, whether it be to buy a home, to buy a car, or various other major purchases that we all make in our different respective lives. So certainly the level of household debt is getting up there. If you compare us internationally to some of our other countries around the world, we do sit quite high in terms of that ratio as a percentage, and certainly that is one macroeconomic factor that we do study in our management of the various portfolios here at Wilson Asset Management. At our heart, as you know, we are bottom-up stock pickers. We're looking for growth companies with a catalyst, whether it be in micro cap, in mid smalls, or in large cap, with the different products that we offer. So it'll be interesting to see how the consumer goes now, in the sense that over the next 10 years, in our opinion, the interest rates are moving higher. And the next move from the RBA, in our opinion, will be our first interest rate rise of this next tightening cycle. And we think that might occur into the next calendar year of 2018. So that certainly, we think, could potentially, and as it normally does, slow down economic growth here in Australia. And what does that mean for us as investors? What does that mean for our outlook for the share market over the next 5 or 10 years? Well, as Jeff talked about, we're now 8 years into this bull market. Someone said to us the other day, it's been the most hated bull market of all time. Generally, it's risen on fear. People have been underinvested over the last 8 years. They've held high levels of cash. People are still holding high levels of cash out there, and so there is a lot of scepticism around how much higher the share market can go. And what gives us short term, we are more positive on the market. Medium to longer term, we are more cautious, given that we're now 8 years into this bull market, which is much longer than we've seen previous bull markets. The average duration in history, based on our research, tells us it's been around that 5-year mark. So this one has been a little bit longer. What we have started to see, though, is we're starting to see earnings per share growth coming through to really justify a lot of the multiples that are being paid for various companies out there at the moment. As long as we start and continue to see those earnings coming through from the various companies that we study here in Australia, that will give us a lot more confidence on the outlook for the share market, and we can see that the earnings are needed to take the market to the next level, if you like, here in Australia. The mining recovery. This one here, we've clearly seen the mining sector bottom in the last 12 to 18 months. For those of you who know us quite well, you would know that we're not big investors in the resources space. We tend to spend more of our time on the mining services companies, and we've listed a range of those companies up there today. With the WAM Leaders portfolio, we've put up that we've invested in BHP, Rio and Oz Minerals. But certainly we have seen the mining sector clearly bottom after a period of 6 to 7 years where it really did languish and struggle for quite a long time. And there has been a resurgence in the resources stocks. They have been one of the best performing sectors, along with the banks, in the last 12 months, and have really driven the ASX to around that 6,000 mark. And that's really on the back of global growth improving, which is quite normal for this point in the cycle, and also the Chinese stimulus. We saw the largest stimulus program of all time come into the Chinese economy in the last couple of years, and that's really stimulated economic growth clearly in China, where it's hovered around that 6 to 7% growth level. So that hard landing that some people were looking for in China just hasn't occurred. And that's really given a lot of these resource or mining services companies another leg up. And some of the companies there that we're invested in, you can see there on the slide in the various different portfolios that we manage. What I'll do now is hand it over to Matt Haupt to take you further into our views around the share market. Thanks very much.
Thanks, Chris, and good morning, everybody. The next few slides I'll walk through are our views on the global macro environment. Then I'll talk about the Australian consumers, the private health sector and the telco sector. So probably the most important message I can convey today around the global macro environment is we are in the best conditions since the GFC. The global economy is performing well. The US has really been the driver of this, along with China. So if we look across different regions, the US is probably in the mid to late stages of the cycle. They're a lot further ahead than the rest of the world. The Fed are actually tightening, they've unwound QE, and we're really looking for the next leg in the US. So far, the data in the US has been quite soft, with the leading indicators being very, very strong. The key for the US now is Q2. Will there be improvement in hard data in Q2? We think that there will be, given all the surveys we're looking at suggest a really big pickup. Some of the key factors we're watching in the US over the next few months is spending on business capex. That will be a key driver. We haven't seen a pickup yet. And durable goods and personal consumption. The reason why we haven't seen personal consumption flow through yet is consumers haven't taken on debt yet, and also the wage inflation has been quite benign. The labour market is tightening up. If you watch the non-farm payrolls every month, the unemployment rate is coming down, and we think the wage inflation will be the next driver in the US. So we're quite bullish on the US economy, but with the proviso around that Q2, if we don't get an improvement in Q2 data, I think there could be weakness in global share markets. So it's really important to watch that Q2 data. And if we look at Europe at the moment, Europe, they're a bit behind the US. So Europe, they still have a QE underway. Again, all the leading indicators, so I'm talking about the PMIs and ISMs, globally are really, really strong, and they're leading indicators, so you'd expect the hard data to improve. So Europe is probably the most favourable as far as position on the cycle goes compared to the US. Much more early stage, and the equity market's reflecting that, so there's probably more opportunities in Europe on the equity front. If we look at China, Chris mentioned back at the end of 2015 calendar year, they went into a large stimulus program because the global economy hadn't picked up by then, and they were worried about their growth levels. So on the back of this, the largest stimulus was implemented, and we saw a lot of the resource stocks in Australia run off the back of this. And this really led the global reflation trade, which we saw pick up through end of 2016, and again in 2017. This reflation story is the key to equities going higher. So I guess the key point here is around that inflection point. Over the next few months, we'll get key indicators whether this rally will continue off the back of good macro data. If we do get good data, we think the share market probably has a few more months in it off the back of this latest rally. And I guess for Australia, Australia is really dependent upon China. So originally I was going to come here and talk about the deleveraging in China, because recently the way the Chinese system works is through the banking sector and through the non-banking sector, which they call shadow banking, which is predominantly banks issuing wealth management products, so it doesn't go through the normal channels of banking. What we saw over the last few months is a real big draining in the liquidity in the Chinese economy, and that's why all the resource stocks are off, and commodity prices. You would have seen iron ore off 25-30%, met coal off 30-40%, and this is really liquidity driven. So originally I was going to come here and talk about the liquidity being drained, but just in the few days we've noticed some people on the ground talking about the government pulling back on the tightening. So our view is potentially changing here. It's really dynamic at the moment, but it looks like the Chinese government are a little bit worried about the speed of the reduction, and they look like they're going to pull back on some of this tightening. So if this happens, resources could get another kick along. So it's something really evolving right as we speak, and we'll be monitoring this situation. So Australian consumers, probably the framework to talk about the Australian consumer is around how much money they have. So if I start with that, the gross disposable income for the Australian consumer is $1.15 trillion. Of that, $330 million is discretionary, so what is freely available to spend. Obviously there's non-discretionary items as well. So if we look at that $330 billion of free discretionary income, we've done some studies around the national accounts to work out the impact of the interest rate hikes which we've seen, which Chris talked about, on investor loans, also power prices and health insurance. We estimate around $5 billion has come out of the consumers' pockets and will come out of the consumer pockets over the next 12 months. So we think the consumer space, especially in that discretionary end, will come under a lot of pressure. You've already seen this through various earnings. You've seen Myer downgrade, Oriton, RCG. I mean, the list is quite long on that retail sector. So we think the retail sector will come under a lot of pressure, and that pressure will continue. In June, July of this year, APRA will come out on a definition of unquestionably strong for the Australian banking sector. We think they will come out on with increased risk weight holdings, which will translate to higher capital for banks, which will translate to higher interest rates on people's loans. So again, we think there'll be headwinds in June, July, and we've worked out around a 10 basis point change in interest rates is about $1.4 billion hit to the economy. So that impact is coming through now, and we expect further. So we're just really concerned around the Australian consumer and any stocks related to that. But the great thing about the stock market is it's forward-looking. So already a lot of these consumer names have adjusted their share prices. They're trading under historically low PEs. So you've really got to take a view now. If you think the Australian consumer can push their way through this or shift their spend, you could potentially turn bullish on the sector in the next 6 months. Because we find the share market generally overreacts to situations. They generally reprice everything lower, expecting the worst, and then reality is sometimes different. So we think this sector is under a lot of pressure now. We don't think there's a lot of value here, but eventually there could be. And some of the names there, we talk about exposures we have there. So Afterpay, Flight Centre, JB Hi-Fi, Nick Scali and Woolworths. Obviously Woolworths is a very defensive company and that doesn't fall into discretionary spend, it's non-discretionary. But a few of the other names there are discretionary. So Afterpay is a business which gives interest-free, essentially interest-free loans and stimulates a business's activity. So we think that can absorb some of the shocks. And again, JB Hi-Fi is probably worth talking about. Come under a lot of pressure around consumer pressures, but also Amazon. And again, the share market will factor in the worst. So already stocks have come off because of the threat of Amazon. Amazon will no doubt impact a lot of Australian consumer stocks, but we think the impacts will be quite low in the short term, and over the medium to longer term they'll probably play out, but we think the share market will probably overreact in the short term to some of these threats. So the private health industry, as I talked about there, is potentially a headwind for consumers. So on average, Australians spend about $21 billion on private health. About 47% of the population is covered. And the major players here are Medibank, they have 29% market share, and Bupa with 27%. So this industry as a whole, we think some of the dynamics here are quite favourable. We think the population, the ageing population, the need from the government to have a strong private health sector is very favourable to some of these companies. So the way we're playing these themes are through stocks like NIB and iSelect. NIB, for us, they have a low market share, so they have the ability to grow in to a larger market share, even though the overall market is not growing much. To give you an example, NIB, in the first half 17 fiscal results, they took 50% of the share of the overall growth. So you can sort of see how this company is coming from a lower base, they have a very competitive product, and are taking almost 50% share of the growth in the market. So they are in a very strong position, and we think their offering is resonating with consumers. They've been the first to come to market with a white label for corporates, so you've seen companies like Qantas adapt their product. Also Suncorp have taken on their products too. So we think NIB are probably the leader and the thought leader in this industry, and we think this was likely to continue. Another company we talk about there is iSelect, a comparison site. Obviously when you've got power bills going up and health bills going up, people, if they're starting to struggle, look to these comparison sites to get the best deal. So we think these two companies will participate favourably in the overall movement of this market. The next sector here I'll talk about is the telco sector. So the telco sector, for us, this is a very interesting sector. The biggest impact here has been the transition to the NBN. This is the biggest shake-up to the industry since the deregulation of Telstra and the opening up of competition. So again, Australians spend about $21 billion on telecommunications, a very large chunk of their overall spend. What we're seeing now is companies in a downgrade cycle. And why is this? This is because they're moving to the NBN world where they don't have a competitive advantage on costing. They're paying the wholesale access charge to the NBN. And previously, when they were using their own networks, they were making a lot more margin. For example, TPG, which we've listed there, previously under the old model, they'd be making about $24 of earnings per client. In the NBN world, it can go down as low as $18 per client. So you have a whole big back book, which was earning a higher margin, transitioning to a lower margin front book. So we think the trend will likely continue for a few years. You've seen Telstra, their last result was really poor, and they had a big margin decline in that core retail business of theirs. And again, this is just the impacts of moving from different infrastructure to the NBN world, where the NBN economics are really hurting some of these companies at the moment. So the way we look at it is we've got opportunities to participate in some of the sectors or the companies that aren't impacted as much. So NextDC for us is a play around data. So they have data centres nationally, and they really are having a great time because of the great thirst for data at the moment. So they're filling up their DCs very quickly, and we think the earnings trajectory will be very strong over the next few years. Another company there, Superloop, early stage business, selling a lot of dark fibre and other add-on services. So again, we think this is the area you want to be in, around dark fibre, not on the retail side. We've also got TPG there, just as this is an early investment. We've recently put some money into it. We do recognise that there's potential headwinds, but the play here is around their mobile offering. They came out with a bid on spectrum, and we think they can push into the mobile market quicker than people think, which will arrest some of the decline on their back book on the old pricing. So we think their mobile offering over time will be able to compete with Telstra. We think it'll be quite compelling. We think they can get higher than 5% market share, and we think there could be a potential roaming deal with another company like Vodafone in particular. So we think, despite all the noise going around in this sector, we think TPG could actually benefit over time, recognising there's potential earnings headwinds in the short term. I'll now hand over to Martin Hickson, who'll run through our top 10 holdings and a few stock stories. Thank you.
Thank you, Matt. So this next slide has the top 10 holdings that we hold across the group. So in the WAM Capital, WAM Leaders, WAM Research and WAM Active portfolios. I might pick out a couple, I won't talk to all of them. The first one on the list, Challenger. So Challenger are a large annuities provider. They have a large dominant market share in Australia of over 80%. Kate, Chris and myself are all ex-Challenger alumni. We started our careers there many, many years ago, so we have a good understanding of how Challenger operates. Challenger have got a significant tailwind going for them at the moment, and that's that transition as people move from the accumulation phase of super into the pension phase, where they start drawing down on their super balances. And that's the key point when people start looking at annuities. The key catalyst that we bought Challenger for was the new distribution deals that they had announced. Challenger had signed distribution deals with Suncorp, Colonial, Mitsui Sumitomo, and more recently AMP and BT, which will commence in the first quarter of FY18. And these new distribution deals are significantly increasing the growth in the annuities business for Challenger. They're experiencing very, very strong growth rates, and we expect that will continue over the next couple of years. At the moment, they're quite well capitalised. They've got $1.2 billion worth of excess capital, so well funded to fund that growth over the next few years. Woolworths and Hunter Hall, we'll touch on those two stocks later in the presentation. AUB Group, formerly Ausbrokers, they're a large insurance broker. One of our analysts, Oscar Oberg, used to cover Ausbrokers while he was at CLSA. So he's got a very good relationship with the company. He's covered it for a number of years and knows the business very, very well. For the last few years, they've been going through quite a benign environment where there's been low to no growth in insurance premiums. More recently, from the analysis that we've done, talking to a lot of industry contacts and competitors, we believe that the industry is now starting to experience premium growth for the first time in a long time, premium growth of around 5 to 7%. And Ausbrokers' earnings have strong leverage and exposure to increasing premiums, so we think that that's a key catalyst that will continue to re-rate the share price and grow their earnings over the coming years. Historically, AUB Group or Ausbrokers have been very, very acquisitive, so we think additional catalysts in the near term, near to medium term, could be additional acquisitions, which would also add to their earnings growth. Nick Scali, another large holding for us. It's a stock that we've held in the portfolio for over 12 months now. It's a company that we've met with every 6 months for the last 5 years. It's always been very liquid. It's been hard to buy a meaningful position in the company. That all changed around 12 months ago when members of the Scali family reduced their holding in the company. The CEO, Anthony Scali, took that opportunity to increase his stake in the business, and we were also offered stock to purchase at that point, which we took advantage of. So it's currently a substantial position for us. We have reduced our holding more recently, Since we bought shares at $3.80, the share price has almost doubled. As Chris mentioned, we think the housing market is starting to peak, which is why we've taken the opportunity to take profits in Nick Scali more recently. Over the 12-month period that we've held it, they've announced 4 earnings upgrades, and that's been the key driver of the company's share price over that time. Stock stories. So the first stock is a research-driven stock. It's a position that worked very well for us over the last 12 months. It's Credit Corp. So Credit Corp are effectively a large debt collection business. They acquire purchase debt ledgers from the banks and large telcos. They might pay 10 to 20 cents in the dollar for that debt, and then they go out and collect it. And the returns that they make are anything in excess of the price that they pay for that debt. It's a company that we've held numerous times over the last 10 years. Over that period, we would have had over 50 meetings with the management team. So we know this business very, very well. At points over the last 10 years, it's been the top holding in our portfolios. So we do know the business very well. The management team, we think, are one of the best management teams in the market. Over the last 4 or 5 years, they've proven to be very conservative. They've often outperformed their guidance, and we believe that they can continue to do that. So why did we buy it? We started buying shares in Credit Corp back in January 2016, and that was following a 25% fall in the share price. The reason why the share price had fallen is many people in the market, both other fund managers and sell-side equities brokers, were concerned about Encore, which was a large US debt collector, moving into the Australian market. They had bought 50% of Bay Corp, and the view in the market was that they were going to be very, very aggressive buying these PDLs, and that would impact the returns that Credit Corp would make. From talking to a lot of unlisted competitors and doing a lot of research on the sector, we formed a view that this risk was overstated, and so we started buying shares in January 2016. It fit our research-driven process really well. It was unloved at the time. It was not well owned by the institutional shareholders who had sold out. It was poorly covered by the sell-side analyst community, and it was cheap on 11 times PE. And we thought it could grow its earnings by around 15%. So it really fit that research-driven model for us on attractive valuation with strong earnings growth. The key catalysts for Credit Corp, we thought, were earnings upgrades over the period. We thought that the Australian PDL business would continue growing at strong rates. We thought that their new consumer loan book would start to deliver strong profits, and that's been the case. So in FY15, that consumer loan book made $1 million profit. In FY16, it made $6 million. And in the recent presentations from Credit Corp, they've guided to that business making $10 to $11 million profit in FY17. So that's been a significant driver of the company's earnings over the last 2 years, and we think that they will, could continue to be the case. In October last year, 2016, following an almost 100% increase in the share price, Credit Corp started looking fairly expensive on a valuation basis. A lot of fund managers had discovered the company, and so we took the opportunity to sell the majority of our holding. We sold over $20 million worth of stock at just under $20. Then subsequent to that, the share price fell post the February result, fell back to $17. And so it got back within our valuation range. So we bought some more stock on the trading side. And the key catalyst now is the growth in the US business. A lot of the US competitors are talking to an improving market conditions over there. They're talking about PDL volumes increasing for the first time in a number of years and prices continuing to fall. So that improves the returns that Credit Corp can make on that US business. We think over the coming few years, the US business has the potential to be a similar size to the Australian PDL business. So that could be a significant driver of their earnings. One that didn't work, also on the research-driven side, is Ardent Leisure. Before we get into the details, the tragic events at October last year remain in our thoughts, and our thoughts go out to the families involved in that incident. While this did have a material impact on the share price of Ardent Leisure, this wasn't the reason why we got the investment wrong and why we lost money on the investment. So why did we buy Ardent, or what was it at the time? When we started buying shares in Ardent back in February 2016, it was a large consumer entertainment business. It had a number of businesses. It had the theme park business off the Dreamworld on the Gold Coast. It had a gyms business called Good Life, bowling alleys called AMF Bowling. marinas, the D'Albera marina business, and also the Main Event complex in the US. And the key attraction, or the reason why we bought shares in Ardent, was that Main Event business. Main Event at the time had around 25 centres. They were growing centres by around 25 to 30% per annum, so a very, very strong rollout profile. And we thought that that was going to be the key driver of their earnings. They were also going through a non-core divestment program, and over the period that we held the stock, they divested their marinas business, and surprising to us and to the market, they divested their gyms business. And the reason for that was they were selling those businesses to deploy that capital into that Main Event business so they could continue rolling out these centres and growing the earnings of Main Event. We did a lot of research on Main Event. 2.5 years ago, Chris, myself and John all went to the US. We saw Main Event and some of their competitors. And then one of the analysts in our team also went back there in September last year. And from all the research that we'd done, we thought that Main Event was continuing to grow, that they were producing strong like-for-like growth. And so that was what really attracted us to the Ardent Leisure story. In January this year, the company came out with an update in the first week of January. They gave an update around Main Event. Like-for-likes were slightly below our expectations. However, they were largely in line, slightly below, but it wasn't a disaster. So we continued holding shares in Ardent. At that announcement, there was no talk of the margins that the business was generating. Then in February, at the half-year result, the company came out with their earnings numbers, and what we saw as part of that release was the margins in that Main Event business had declined significantly. And what we hadn't realised was that there was increasing competition in the space, and while they were still driving store traffic through these centres, they were having to discount heavily, which impacted their margins. And so at that point in time, our thesis was no longer intact, so we ended up selling our shares in Ardent post the release of that result. I'll now pass over to Tobias to talk about two stocks we currently like in the portfolios.
Thank you, Martin. Good morning, everyone. My name is Tobias Yao, and today I'll be going through two companies that we currently like. No doubt some of you would have seen the TV ads by iSelect, where they try to persuade you to change your health insurer. In fact, both Chris and Martin within our team have actually used their service. So they called up the hotline, they had a sales representative engage with them. And these sales reps, they're very persistent and sometimes quite aggressive. But the most important thing is they're very good at their job, which is to change a lead into a customer. And in our case, they were two very happy customers. Since their listing in 2013, iSelect has evolved to be the largest comparison website in Australia, now covering 7 different categories. It has a market capitalization of $450 million and is trading on a PE of 19 times. And as you can see, we own it in WAM Research and WAM Capital. We first purchased iSelect in February of 2016 after we attended a results briefing where we're the only investor in attendance. Now, as we often find with our best ideas, these are ones that's undiscovered and disliked by the market, and our job is to figure out whether that's warranted. In that case, our meeting was on the back of a company downgrade in earnings and also a change in the CEO. After we met with the new management team, we were very impressed with the new strategy, and the new strategy was simple. It was to improve brand awareness, increase the different verticals, increase customer conversion rates, and also improve productivity. At the same time, the balance sheet, they had a lot of balance sheet flexibility with no debt. So we saw the positive catalysts being potential M&A opportunities and also capital management initiatives. And as a result, we initiated a position. As the year progressed, management's revitalized strategy contributed to iSelect achieving the top end of its FY16 EBIT guidance. This, combined with the announcement of a share buyback, pushed the price up to currently around $2.04. So what are the catalysts now going forward? As we sometimes see with companies we invest in for turnaround in earnings, they revert into a company that has been refocused to achieve growth. We see a favorable industry dynamic, as Matt mentioned earlier, for iSelect at present, with consumers increasingly looking for cheaper alternatives in the areas of health insurance, internet, and electricity. At the same time, the competitive environment is quite favorable. So for these reasons, we expect strong earnings momentum in FY17 and potentially future acquisition opportunities that will drive earnings into FY18. Moving on to large cap stocks, and Woolies continues to be an attractive investment for us. I'm sure all of you are very familiar with Woolies. Most likely in the past, as you did your grocery shopping, you would have commented on the difference in price, the difference in products, and the overall look of the store between Woolies and Coles. You may have also seen in the press the tough time the company has experienced over the last 7 years as Coles has improved its offering to the customer and also led an aggressive price discounting strategy together with Aldi. During that period, Woolies decided to maintain their price to improve their margins. And as a result, Woolies experienced 29 successive quarters of market share losses, and the margins fell from around 8% in 2010 to about 4% last year. Like the previous stock iSelect, what initially piqued our interest was a change in management, a change in CEO to the new CEO, Brad Banducci. So we understood that to turn around a large organization such as Woolies requires change from the top, and at the same time, you need to have a refocused strategy and cultivating a culture that likes to make incremental improvements throughout the organization day in and day out. The refocus on you, the customer, and also on price, and the simplification of the business through the exit of Masters and a couple of other business divisions gave us increasing confidence that Woolies can win back market share over time and drive growth in their grocery division. As a result, WAM Leaders started buying Woolies in August 2016. As the months progressed, it became quite evident that the management strategy was working. In fact, the team did quite a few fact-finding missions where we met with industry veterans as well as suppliers. And what we learned was the fact that the new service offering and investment in price is resonating with customers. The catalyst when we bought the stock was for improved like-for-like sales momentum, and pleasingly in the December and March quarters, we saw that occur. Going forward, we see several positive catalysts, including margin improvements driving earnings growth in FY18, as well as further divestments of non-core assets. Thank you very much, and I'd now like to pass it on to Alex Hopper, who will conclude the formal presentation. Thank you.
So as Kate mentioned earlier, before we open up the floor to questions, we're going to address some common questions we've been asked over the past few months. I think we're just waiting for Jeff to come in. Yeah, Jeff's got the first question. Yeah. Okay, Matt, I'll just start with you. So we became the investment manager for Century Australia on the 18th of April this year. What plans or changes do you have for the investment portfolio, and when will the investment team roll these out?
Thanks, Alex. So the Century portfolio, as Alex mentioned, we became the manager just recently. We're currently going through the portfolio now, working out what changes we're going to make, and then put them to the board and also to the tax council just to get advice on obviously we need to utilise the tax losses. So I'd expect all these changes to be made in the next few days, and then the portfolio will reflect the way we manage the money, like the other WAM products, within the next week or two. So that's the update on Century.
Thanks, Matt. So Jeff, a question for you. Can you please provide an update on any other listed investment companies that we're invested in? For example, Hunter Hall, Wealth Defender, AUB, Templeton Global, etc.
That's right. As I was saying before, our main investment strategy is finding those undervalued growth companies and only buying them when we see a catalyst is going to change the valuation. Otherwise, we'll sit in cash. And that's probably because when we started, half of the money in the fund was my money, and I didn't want to lose any money. And so that's the investment logic. But when we're sitting in cash, if we can see any opportunities that we think are sort of low-hanging fruit, where we can make money, then we do that. And obviously, you know, I've spent a lot of time analysing listed investment companies, and when we see other listed investment companies potentially trading, like $1 of assets trading at 80 cents, then we're very interested in buying them if we believe that if they do various things, they can get that share price back to $1. And we probably use a combination of carrot in terms of we show them what we do, we explain to them how we believe they should do it and what's important, and then I suppose if they don't do it, we use a bit of stick. And that sometimes works well, sometimes doesn't. In terms of, I suppose, Hunter Hall specifically, what we saw there is when Peter Hall left, we were very disappointed with his sort of shock resignation, and we believe that the board should do the right thing and ask shareholders what they want to do with the company, similar to what Century Australia did when Peter Morgan left, and similar to what we did with Australian Infrastructure Fund. You know, when they were winding down, we did the same. And we had we were bid for our shares in Hunter Hall by someone early January, and we had an opportunity to sell. We thought the position then was strategic, so someone could have potentially paid a premium to NTA when everyone was positioning themselves for the bid. And also, we looked at our shareholder base, and 20% of Hunter Hall's shareholders by number were WAM Capital shareholders. So we thought it was important that we stood up for those shareholders, and what we believed is held the board to account. Anyway, and that was that situation. But all the listed investment companies, you know, we think that, you know, the sector's a very interesting sector. You know, it's got a great future. And yeah, if we can buy $1 of assets for 80 cents, we will. And potentially if we can sell them for $1 or above $1, we will as well.
Thanks, Jeff. And another question for you. Can you please outline the recent acquisition of an unlisted investment company? That's right. We did our first acquisition of an unlisted investment company. It was sort of a merger at NTA for NTA. About 15 years ago, we had an opportunity to buy one, but we weren't successful in that occasion. And we bought it probably two main reasons. It was assets for asset swap, and it was the portfolio. It was a $25 million investment portfolio. It was the portfolio, and also it was the shareholders that we inherited. Now they're some of our biggest shareholders. And one of the secondary benefits was there was a little over $4.6 million of franking credits in the investment company. So that would allow us to pay about a $10.8 million fully franked dividend. So that was sort of a secondary benefit, but a significant secondary benefit. Thanks, Jeff. Chris, can you comment on the recent performance of the portfolio, including share price performance?
Thanks, Alex. Jeff really covered off the share price performance, I think, particularly for WAM and Capital and WAM Research earlier, so I might leave that one alone. In terms of the portfolios and how we've performed over the last 6 months, we've been slightly below the benchmark. It's been a really tough period as investors, and one of the toughest periods I think we've been through in a long time. And one of the few observations to make, firstly, we've seen the small cap sector largely underperform the large cap sector by around that 10% mark over the last 12 months, and so that's been a interesting dynamic that we've had to cycle through. And when we met with you 6 months ago, we anticipated that would be the case, and it's continued to gather momentum in the last 5 to 6 months in particular. We've seen an enormous amount of money being lost out of the small cap market in the last 6 months. We would estimate anywhere from $4 to $5 billion that's come out of the small cap market, and lots of fund managers, and that money's either been going to other fund managers that manage large cap mandates, global mandates, or it's been internalised by some of the large super funds with the institutional mandates that are in place out there in the market today. So, and the other feedback that we get is when people look at our performance, not only in the short term, be it the last 6 to 12 months, but over the medium and long term, we still stack up really well relative to a lot of our peers. We are seeing the last 12 months a lot of active managers underperform the market, and that's really driven the debate and the move towards passive, which we can talk to if there is interest later on in the Q&A session. But certainly over the medium to longer term, we've got a strong track record in outperforming through all market cycles. We've got as you can see here, we've got all of the investment team up on here on the stage, barring one, Cooper Rogers, who joined us only 2 weeks ago. We've got plenty more muscle than we have ever had before, an 8-member team, and we're working as hard as we ever have before. We're seeing 1,500 companies a year. We're researching companies more than we ever have before, and particularly having the WAM Leaders product come on in the last year or so has certainly been a major benefit, we think, to the portfolio and to shareholders, for not only for WAM Capital but for WAM Research and for WAM Active. So we expect that those synergies will continue as we go forward from here.
Thanks, Chris. Kate, a question for you. Wilson Asset Management has recently grown its funds under management and its stable of listed investment companies. How have we responded to this growth?
Thanks, Alex. And I think Jeff also covered off on this in his presentation and really talked about the growth of the team. So I'll probably maybe jump to the next one.
You can introduce the team. The rest of the team. I think they've gone. Oh, they're here.
They're spread out.
Where are the other guys? I saw. Oh, there they are.
So we've got. So who have we got up there?
Meredith.
Meredith.
Marty.
Yeah.
Who's
Marty.
our content strategist? Marty McCarthy, who's our general manager.
Yeah. Put your hand up, Marty.
There he is.
With
A lot
the
of you have
accent.
probably spoken to Marty on the phone, and James McNamara, our head of corporate affairs. Where's
He's
James?
outside.
Oh.
Is he?
Yeah.
He's doing a press release.
Okay, on to the next one.
Yes.
Oh,
Kate
Alison.
Yeah.
Down here.
and Natalia.
And Natalia,
Oh.
one of our newest comms team members. So we've really been growing the team, not only on the investment side, but also in the support side of the business. Obviously, we do all of our NTAs and finance in-house to ensure high quality, and obviously all the marketing and communication, of which hopefully you all get a big benefit.
Thanks, Kate. And so what is Wilson Asset Management's succession plan?
Succession plan. I mean, in terms of succession, we sort of, how I view it is this sort of short-term and long-term. Short-term played out yesterday when half of us missed the beginning of the Melbourne Roadshow because we were all on separate flights. So that sort of didn't really work out too well. But in terms of, you know, and again, sort of we've grown the team and it's ensuring that we're sort of hiring the right people and have the right resources in place. I mean, longer term, Jeff's mentioned his retirement age. I think now after being at the Berkshire AGM, I think that's now being pushed out even further. But really, I mean, in terms of sort of running the business, Jeff, Scott, myself and Chris, we've both been in the business for over a decade each. But the key is going to be ensuring that our culture and our purpose really lives on well beyond all of us here in this room. So that's something that we discuss and are quite focused on.
Thanks, Kate. And just to wrap up, Jeff, you recently returned from the US attending a number of investment management conferences. What insights can you share from your trip?
Thanks, Alex. I'll just tell a little funny story. So I was in New York and catching the plane to Omaha, and the great thing about, like, I'd never been to the Berkshire Annual General Meeting before, but the great thing about going there, it was like the Sydney Olympics. You know, everyone's in a good mood, and everyone's only going to Omaha that weekend for one thing. So on the plane, you're talking to the person beside you. I just had some carry-on luggage, but for some reason they put it all under the plane, so we had to wait when we got off the plane for our bags. And there was a lady there, nice lady, with a young son. The son was, well, I found out later he was 14, but he was, you know, slightly taller than she was. Anyway, just talking about why you're here. Oh, going to the Berkshire, yeah, very excited. And I was thinking, how nice, the lady's taking her son to teach him about investing at the meeting. Anyway, the next night there was a dinner. It was Columbia Business School had a dinner, and they had 4 really respected fund managers that were presenting. Mario Gabelli, who's manages $40 billion. I know Buffett's done, I think, 22% per annum for whatever period. Mario's done, I think he's only done 15% per annum. Since he says 1977. It sounds grander. But that's, anyway, we arrived at the dinner, and there was another Australian I knew there, and he was speaking to this gentleman, and he was speaking to the nice lady I saw on the plane and a young son. And I'd been reading something about compounding. I thought, look, I sort of felt I had to. I was having a chat to the young guy and asking him how old he was, and I said, look, I'm 59, you're 48, and I said, look, if you get $5,000 and you invest it with someone, and if you can do, I think the figures, if you do 14.82% per annum for 50 years, that $5,000 will be worth $5 million. And I thought, look, I'm really, and that, that Buffett talks about, the snowballing or compounding, the incredible benefit of compounding. And thinking I've really added value to that guy's life. And he sort of said, well, where do I get that? And I said, oh, well, you just got to find someone, maybe you invest, do some work on investing. So we go into the dinner, I sit down there, I look up on the stage, and the 4 people, his mother was one of the fund managers. I looked for them afterwards, but I couldn't find them. Anyway, so he obviously would know a little bit about that. But it is a great atmosphere, and you've got to get up early because they open the doors at 7 o'clock, and it's just like there's 40,000 odd people, and it's good luck where your seat is. So I set the alarm for 4:30. We got down there a little after 5, and you're just meeting people. You're standing in the line. You're talking about stocks. Another guy from Australia. You meet a lot of Australians. But what did I learn? I would say, and as we are, as I've been for a while, a bit nervous of the market. I think that lady, she was 22.5% cash, and that was the highest level she'd ever been in terms of cash in her portfolio. I think she had a $10 billion portfolio she managed. Gabelli was sort of, thought the market was pretty fully priced. I think everyone was along those lines, that the market had been fully priced. And you've got to remember, the US market, it's the 3rd longest bull market ever. It's been going for 8 years and 2 months. So we're at a mature stage of the bull market. I think they're a bit concerned also that the volatility has declined significantly. So, if there is an adjustment, it might be quite swift, as we saw yesterday in WAM Capital. Bit of an adjustment. I did notice they're up 4 cents today, so bit of a bounce back. So to me there was definitely everyone was a little bit concerned. One thing that makes me probably a little bit positive on the short term is that probably everyone I spoke to was nervous of the market, and you tend to find is when everyone's set their portfolio in a certain direction, maybe the market keeps going for a little bit longer.
Thanks, Jeff. So that now concludes the formal part of the presentation.